The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, Monty here, market analyst at IG UAE. It is a Tuesday, it is 5 p.m. and that means it's time for us to tackle another webinar, although we are going to do things a little bit differently this time around. It's not that we haven't talked about tools before when we looked at IG's trading platform. It's not as if we didn't talk about some of the other items that are available when we looked at our stock trading and building your portfolio. But this time the focus is really going to be about the tools that are available in order to help you trade better, regardless of whether or not sometimes we feel we should or should not use them. And by the way, for this webinar, we also are going to do things a little bit differently, not just in terms of the topic, but in terms of how we're going to go about doing it. We're going to have my colleague Faizan. He's joining us for this webinar. He's going to ask the question. It's going to be a bit of a Q&A back and forth. He brings up the question, I then answer it, and then we go through the presentation. Faizan, why don't you go ahead and introduce yourself and kick us off with the first question.
Hello, everyone. Thank you, Monty. My name is Faizan, and I'm in the new business team. I'll be taking all your questions, any questions that you guys have related to the webinar. You can just type them in. I'll bunch up the questions, and when appropriate, I'll ask those questions from Monty. Apart from that, I do have a bunch of questions that most of the clients have been asking us already. Starting off with one of the most famous as how do traders usually go about it? I mean, there are tools available for trading that can help us trade better. But how do traders usually go about it when they first start engaging with financial markets?
Yeah, so in this case, a lot of times I kind of got to start with that unfortunate initial story. I'm going to include myself in this as well. Whenever I started trading, I think a lot of us can go ahead and do it, but a lot of times you have a certain amount that you want to trade CFDs with. The first thing you find or you can hear about, ignoring even what the product is, ignoring what the market conditions might be, volatile, not volatile, has there been something big hit in the markets or not? Regardless of that, you just go, okay, first thing I hear, I heard about this trade, and then you sort of go all in without even looking at the leverage or margin and how much it might take out of the total funding that you've allocated towards this trade. And the thing is that there's nothing wrong with the idea of saying, okay, I've got a trade in mind. I've heard about this trade. I want to go ahead and look into it. There's absolutely nothing wrong with doing that. It's just the way in which we go about it. We sort of grasp onto it and we go, okay, all of a sudden we're going to go ahead and we're going to go all into it and we're ignoring the stop loss. We're sort of, because we're just assuming that it's going to be a quick profit and of course, we're not utilizing what's at our disposal that might improve our trading. We sort of view it more as an added help and not a tool, because let's face it, when that triggers in us, and there's nothing wrong with being prepared in terms of having your account ready, having the financial firepower ready, and then afterwards going ahead and utilizing it so that you can place that trade. There's nothing wrong with that, being ready for such a trade. But a lot of times that it's sort of the initial trigger for it a lot of times is, okay, heard the trade, let me go all in, ignore the stop loss. And yes, there are tools available, but it's okay. I can handle on my own right now because I know this is going to make money. That's the reason why we're even ignoring a stop loss. We're just assuming there's no way it's going to make a loss, and that means that we're hoping for a sort of quick profit. And of course, we want to avoid that. I'm not saying there aren't points in this that might be interesting in terms of trading a certain opportunity, but we want to note the reward, we want to note the risk, and of course, it's important for us to try and correct that.
Right. And what is going to be today's agenda then?
So looking at today's agenda, it's going to be about, we obviously want to tackle this a little bit differently. Again, the concept may not always be wrong, but we want to go ahead and do this in such a way that we're in a bit more to ourselves, a bit of a more controlled environment. We want to have a basic and comprehensive product understanding. Okay, which product are we choosing? Even if it's gold, for example, are we choosing the right product within the products that are on offer out of IG in terms of gold? So basic and comprehensive product understanding. We're not just typing search and just hop in and that's it, we're good to go. Okay, double check, make sure we have the right product. It's also the matter of the recommended size and what these margins represent, because I know they're time and time again, you mentioned what leverage and margins, and at the end of the day, we're still a little bit confused, and there's nothing wrong with that. Some of these concepts, there are concepts in life, I'll understand the first time. There are concepts in life I need to listen to a second time, and then I need to listen to a third time from someone else maybe, and then sort of go back and forth and see a little conversation, and then maybe see a video, and then, oh, okay, now it clicks, and I finally understand it. That if it happens to me, I'm going to guess and assume that it's happening to the rest of us as well. So we are going to go through recommended size and what margins represent, and then of course utilizing the tools that we have at our disposal. stop loss. We're going to have to reiterate that again, as well as using risk management. We then have something called trade analytics, which we've launched. And then we've got the smart score when it comes to stocks, as well as the market report that we issue Monday through Thursday, and some of the other items. And as Faisal mentioned, any questions you have, you just sort of plug and chug over there. When it all gets added up and tallied up, we'll go ahead and answer it. Though if it does pertain to the slide that we're in, heck, why not? We can go ahead and take a look at that. So Faizan, to you.
All right. So for most of my conversation with the clients, one of the questions that really pops up, especially for beginners that are new to financial markets, is that we offer around 17,000 markets of forex, commodities, indices, shares, cryptos, and all these markets. They usually ask, how do they know that they are selecting the correct product to trade, depending on the time and what's happening in the market? So how do I identify which product suits them?
Okay, well, I mean, the thing is that when it comes to the product, and before we delve into that specific which one you're selecting within, like for example, gold, I want to say this is not a recommendation of what one should or shouldn't trade. It's more about taking into account the necessary factors before trading a market. Now, if you are trading, for example, Euro USD, well, Euro in general, whether it's the Euro priced against the pound or the yen or the Australian dollar or the US dollar, the Euro is going to get a bit jumpy when it comes to the European session. That's just the nature of the business, right? It's the European session, Euro is going to get jumpy. Same thing when it comes, for example, to the pound, GBP, and GBP pairs. And then the US dollar, a lot of times, I mean, it's the US dollar, so it's going to be jumpy a little more often than not, but it's usually a bit more jumpy when we get to the US session. Same thing when it comes to, for example, shares, US shares versus, say, European shares. When it comes to certain commodities, because they're priced against, say, the dollar, so it doesn't mean that they may not move a little bit in different sessions of the day, but you want to note those things. That's just when it comes to the regular trading session. You want to make sure you're in the right session, or at least aware that, okay, you know what, this is a session where things get a little bit jumpy. Let me put my boxing gloves on. Let me get ready because things might get a little bit volatile, and just mentally, strategically preparing yourself, going, okay, you know what, usually I'm looking at around 20, 30 pip moves during this time period. Oh no, wait, it's out of hours. Okay, things usually get calm, and that means I'm not going to be looking at much action right now. So that's when it comes to the session. That's just day in, day out. You then have those days of the week sometimes where at the start of the week it might be a little bit lackluster movement. If it's a holiday, things are going to be a little bit calmer. Trading is usually a little bit lighter. Then also there's the matter of whenever you have fundamental data, like for example, U.S. non-farm payrolls for risk appetite in general for the U.S. dollar, or now, for example, inflation is quite a hot topic when it comes to traders, investors, policymakers, and yes, that includes central banks. So when it comes to interest rates, the central banks are looking at where inflation is at, which means we got to look at where inflation is at, because if you're trading that currency, the currency of the central bank, they're probably going to be influenced by that. So you want to obviously note those factors, but when you're actually selecting something on IG's trading platform, you look at, for example, spot gold over here. By default, you click on spot, but then you look at under the red box, you got spot and you got futures. And then also, second of all, you got the size of the contract. You can see there's spot gold mini 10 ounce, you got the spot gold 1 pound contract, and then you got spot gold. There is a difference between the sizes of those. And of course, there's going to be a difference between spot and with regards to overnights versus futures contracts and rolling over those contracts. And you can find the full information for this. When you select that product, you click on it, you can go under, you got deal, order, alert. This is on a CFD, IG's trading CFD platform, by the way. You can then go to information and it'll tell you what the contract size per point is, what 1 point means and the value of 1 point. Now, this is very important because if you're going to select for spot gold, if it's the 1 pound contract, that's what you're going to get, but you look for the larger contract and you might be in a little bit of trouble. Otherwise, you could also, another added option, if you don't want to always have to go to info, when you click on the product and then you click on sell and you want to, for example, sell 1 lot of gold, you can also look under deal and order, and you'll see there it says USD. I'll go ahead and highlight it again so the red part comes on. US dollar, $10 per point, and what the notional value is of what it is that you're trading.
Right. And since we are trading all CFDs, contract for difference, that means leverage and margin is involved. So just can you brief us a little on what is margin and how do I see it on the platform?
Yeah, and that, by the way, is right there at the bottom. You see margin 953.45, and then of course, so the matter then is when it comes to size, as well as margin. So for an example, let's go ahead and pick up the spot gold mini 10-ounce contract, and you can see the margin there. It says $953.45. Now, I got to make this very clear because I thought this is the first thing I thought when I first started over a decade ago, and I'm going to guess a lot of you, same thing happened as well. We're assuming that that's some sort of charge. It's not. It's not a charge or a cost. It's used to place and maintain that trade. See, the thing is that, and it's going to be returned to you when you close that position. So that 953.45, don't assume it's going to be, it'll be taken, put aside, if you will, and that will then be returned to you once you close the position. Normally, you'd have to pay $19,000 in this example here when gold is at that price. You'd have to pay $19,067.50 in order to buy 10 ounces of gold. But with leverage, you're only paying a fraction of that. So it can work both ways, in favor and when against. And ideally, therefore, you're going to have to use it with, in this case, with caution. And just to look at this aspect over here, when you go at the top, you'll see that the whole funds profit loss margin available. You got your funds, which in this example, $20,000. You got your margin, as you can see over there, in this case, $953.20 and $953.20. And you got your profit and loss, which in this example, it went into profit. You had a couple dollars of profit. Your equity is going to be your funds plus your P&L. So it's $20,000 and $20,002.10. And look at your available, which is going to be, you then afterwards taking out the margin from that. So when you close your position, the profit loss adjusts into funds and the margin moves back to zero. So now in this example, I closed it at around with a $5.10 profit. So now it's $20,005.10. So that margin, because I closed it, that freed up, and now all of a sudden I've got $20,005, as well as when it comes to available, because now that total amount is available to trade.
I see. And normally, how much of that should I be using towards initiating my positions?
Yeah, well, this is, I guess, where it starts to get tricky, right? Because a lot of times people go to themselves, oh, I heard about this trade. I definitely think it's going to make money, so it's not going to lose. And that means I'm going to go all in. I'm going to put it all. I'm going to take it to the max. And obviously, that's not ideally what you want to do. So keep in mind, in this case, a margin for one lot of a 10-ounce gold contract. Let's go to this example, $953.35. Of course, they're going to change based on the value and all that, but you get the idea. And you want to keep aside for a few items. First off, when it goes against. So if the market's going to go against, which I know the problem is that, this is why I'm saying if you're triggering this based on some trade you heard, okay, you see the opportunity, but you have to always assume it might go against, because we're assuming, oh, it's going to go up. This guy telling me that I'm going to go in, I'm going to go long, or, and that's it. I'm going to go for it all in. Well, what if it goes against? What if that person's wrong? What if it goes against? What if we are wrong? We have to entertain that thought. We might be right, but we might be wrong. And when we are, we need to be ready for when it goes against. Second of all, it's about preparing for when a strategy doesn't work repeatedly. Now, this is also something that we don't mentally want to entertain whenever we're trading. We can always, I'm going to make money. Okay, one time I'll lose, but I'm going to make money all the time. That's not how it works. You could have, and I've put a very, very tough situation here just to drive this point. But if you translate each of these blue bars as a gain and a red bar as a loss, you've got, gain, gain, loss, gain, loss, loss, gain, gain. And I put this as an example. You don't always have this happening, but I put this as an example just to drive the point. What if it's loss, 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 gain, gain, loss, gain, gain. Now, net, by the way, if I've taken an example of 50 and 25, if you actually add this up, you're actually still making money. I know it sounds odd. You'd be like, no, but there's so many losses. Yeah, but that's because you minimize your loss. We'll get to that later. You minimize your loss and your take profit was larger. But you want to obviously be ready for that in the event, what if you end up having a series of losses. You go through a period where you're going through a series of losses. That means you don't want to take on a huge amount to the extent that you're suffering this huge dry patch where you're losing a lot of money. So you're preparing for when it goes against. You're also preparing when you may not be right in successive order. Just what if, right? You just got to be prepared for that. And by the way, I just want to add before I add the next one, but there are times where people are right many, many times in a row, right? Where you have many gains in a row, 5 or 6 times. Again, I just took a really worst case scenario here. So I don't want people to get pessimistic about this, but that's just the way I'm doing, just to drive this point to say, just be on a bit more cautious on the matter of utilizing. And also, if you're positioning further to a side, but not averaging in.
All right. Averaging in is kind of the most common strategy that I've seen from most of the traders. How do I avoid averaging in? And so what does it mean to average into a position instead?
Yeah, I mean, this is kind of unfortunately the situation when you say that a lot of us have to average in. I'm speaking about myself as well. When I started over a decade ago, we've done webinars on this in terms of psychology and why is it that we have a tendency to average in. But basically, what it is you think you're right, or you think that trade that you have is right. You go in and you buy, for example, it goes against. You then continue to add to add to add to add to add, which is a very, very dangerous strategy because on that day where it trends against, you might say, well, it didn't trend, it came back and then it averaged back, and then I closed out and I made a little bit of money. Yeah, but on that day where it goes against, which could be once in a month, could be once in a quarter or once in a week, however often it might happen, but on that time it happens, it could end up into serious losses. So let's go and look at an example of what it means to avoid averaging in and averaging into your position instead. So by default, you look at one lot over here, and in this example, it did manage to rise, which good news. But what if it continued to go down? Average again would say, oh, I'm going to buy another lot and another, and we don't want to do that. We do not want to average, and we want to avoid that sort of strategy. So averaging into a position is when you take one trade, but you break it into multiple positions. Now, the reason why you might do this is because you go, okay, you know what? I anticipate it's going to go up, but my entry isn't that great. I'm not really the best at, I know it's going to go up. It might go against. My entry is not really that great, but I know that within this range, I want to go ahead and I want to be long about one lot. So what you do is you break it down into 0.25 lots each. So you're averaging into your position, 0.25, 0.25, 0.25, 4 times, and then you stop. It's not endlessly, because we know what's going to happen there when the market trends, right? Because that's just breaking down one lot into 0.25 and doing that. That's not what we're doing. We're taking one lot is what we're working with. We're breaking it into 4. And there are times where the market might just trigger 2 or 3 and then go up, which that's why we set this up and broke it into 4, right? You kind of want to get you want to average into the position, not average in endlessly. But what's quite important is you want to make sure you have separate take profit and stop loss for each position, because I'll tell you what will happen. It goes against you slowly, you start to buy in, and then as it goes up, you start to close right away these, because you don't want to, you don't want to lose in the moment it goes into profit. You get antsy and you want to close out, which you obviously don't want to do. You need to have separate stop loss and take profit for each of them, unless you really see some change in the market where the market is telling you that, this isn't sustainable, it's going to get out, it may not reach to this level, then and only then do you consider taking out a little bit earlier. But you want to note that there are going to be times where if you keep taking out too early and your take profits are low, that means you're risking a lot to make very little. And obviously you don't want to keep on adding. This is a pre-planned move. When I say average into your position, it's pre-planned. You're saying 4 times 0.25, that's it. It's not 0.25. Yeah, I'm going to do that 4 times. Then, okay, maybe one more time. All right, there I see some averaging. Oh, let me just, okay, that's 6 right now. Okay, let me go ahead and make that 7. And the thing is, you want to note market conditions before the key events, because otherwise your entry may suffer. So if you're going in and you're used to a time where, the markets are very oscillatory and you're going, oh, okay, I guess I can just, I will average into my position every dollar or two on, say, gold. Well, when the U.S. session starts and things get volatile, or if you've got non-farm payrolls or U.S. inflation or a Federal Reserve event or something big, you're going to get some really, really big volatile moves. You can't average into a position with very, very small levels. You got to be very smart about it. And you got to, okay, you know what? We could be looking at, for example, during the session, a 70 pip move. So if I will wait until it gets to the edges of where I think is the support or resistance levels. Once it reaches those edges, not just right away, just go in. Once it reaches the edges of what I think are the extremes for the session or for the extreme for that sort of move, then I will entertain, for example, every 15 points, for example, or 17 points to go in with a broken lot 3 or 4 times max and end it. And that's sort of how you have to go ahead and take a look and sort of initiate averaging into a position.
So I see some of these red lines here. There are some support levels and resistance level. And if I'm looking into putting some trades or maybe like using some risk management tools, how would I do that on the IG platform?
Yeah, so this is, I guess, we're going to start taking a look at some of the tools that are available. I want to start with the first and most basic one. I know you've seen on the training platform, you're going, why are we going through this again? But you know what? It is that if it serves just as a fresh reminder, let it. But we're also going to get to the risk management afterwards, so it is something to note. But the thing is, before clicking on place deal, you can adjust the stop loss and take profit by dragging the arrow, so you can do it there. But basically, by clicking on the up arrow, and that's dragging it up for the take profit. And on a sell position, that would be the stop loss, because on a sell position, you're going short. On a long position, you're going buy. Whereas on a sell position, if you drag it down, that would be your take profit. And if you drag it up, that would be on a sell position, that would be the take profit.
And every time we try to drag the stop and limit on the charts, we see a risk and reward ratio. I usually go for like 1-to-1, but what would be your recommended kind of like an ideal risk to reward ratio?
Yeah, I mean, 1-to-1, basically, what does it mean? I mean, 1-to-1 means that your stop loss and your take profit are evenly matched, right? And unfortunately, sometimes when the market goes in favor and it starts to fall a little bit, we're like, ooh, it's going to fall, so let me close it before. So it doesn't even reach your 1-to-1, basically. So when it goes against, you're going for the full stop loss. Sometimes, you shouldn't do this, but sometimes we even drag the stop loss. We're like, oh, I don't want to lose. I don't want to lose. I don't want to lose. And we sort of drag it more and more, and then we're losing more and more and more. So we're sort of reinforcing it. But you want to stick and have a very, very fixed stop loss. I mean, you want to be flexible as a trader, but you want to be fixed in terms of there are certain parts where you have to be fixed in that sense, especially when it comes to a stop loss and telling yourself, I do not want to lose more than this. I want to live to fight another day. On a take profit, you can be a little flexible, but ideally you want to be flexible in terms of for more profit. But 1-to-1 basically means that you're evenly matched. So if your strategy is, if you're looking for a strategy that on average is making is right more than 50% of the time, then basically you're saying, okay, now at least I've covered myself in the sense that I'm not losing. I'm not losing. And hopefully I'm gaining if it's obviously much more than 50%. But as an example here, 20 points below, and I put them over here, the 20 points over here, but 20 points below a sell position is the limit to take profit, and 20 points above a sell position, that's the stop. So it's 1-to-1. Ideally, you don't want it to be less than 1-to-1. Now, I know there are people out there that go, hold on a second, what if I have a trading strategy where it's right more often than not, but my take profit is less and my stop loss is quite large? I'll tell you what will end up happening, most likely, unless you're very, very disciplined. What will most likely happen is that you're going to look for strategies to go, I don't want to lose at all, and you're just going to end up risking more and more and more and more to make less and less, to make less and less and less. And so that one loss is going to wipe out multiple trades. And the reason why, by the way, this is a bit of a psychology 101, but the reason why we do that is because it's our psychology of not wanting to lose at all. And we obviously have to overcome that. Because if we say, I never ever want to lose, it means that you're going to risk everything to avoid a loss. And if you risk everything to avoid a loss, the market will come up with that day. There will be a day where it will go and essentially wipe you out. And we want to obviously avoid that. So ideally, not less than 1-to-1, because then you're going to start moving towards risking more and more and more and more for less and less and less. 1-to-2 is ideal, as in your reward is 2. So in the example of 20-to-20, that would be, or I put it over here, that would be 40 and 20. So your reward is 40 and your risk is 20. Beyond that is obviously much better. Like if you say I can do 1-to-3, that's great, but it really requires you have to be very much right on your entry, and there might be times it might be difficult to always get that right. But 1-to-1, not less than 1-to-1. You want to stick with that 1-to-1, if not more, and 1-to-2 obviously being far, far, far more ideal.
Right, and so most of the expert forex traders, what they recommend is that if you are going to incorporate this sort of strategy in your trading, you need to look at your trading decision always in kind of a long-term view rather than just making or changing your strategies after 1 or 2 days of trading. How can I see if I'm doing this right more often than not? Like, what kind of tools would I use for that?
So at IG, what we've done is we've come up with something called trade analytics, and you can find this when you go to your dashboard. And afterwards, I can show you guys where on the platform we go to the actual live platform. But on dashboard, when you look at where your accounts are, you click on live accounts. You'll see live accounts and demo accounts. You just click on live accounts, and you'll see trade analytics right over here. Now, you can analyze your trades over a certain period of time, and you want to make sure that you've selected the right account in case you have more than one account with us. You might have more than one CFD account. You might have, for example, a stock trading account. Make sure you've selected the right account to make sure that that's the analytic. That's what you're analyzing. You're analyzing the account of where the trades that you've recently traded have taken place. And I want to show you guys what it would look like. These are snapshots of what it would look like. Don't worry, I've put over it so it's not, this isn't a client's information or anything like that. But your total return, it'll give you your total return. It gives you your P&L from closed positions and your total adjustments. And your cumulative, you can see your cumulative true P&L as you progress throughout the period, so you can see when you're in loss and when you're back in profit. And the other thing is that it does show your trade. Normally, if you base it on human psychology, you see a lot of little green lines, profit, win, 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 big loss, then win, 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 big loss. And that's not what we want to look at, right? Obviously, you want to have, when we talked about that whole risk reward and stop loss, the idea is that you want to risk less and try and make more. Some big green bars It doesn't have to always be a big green one, because let's face it, you might be in the middle of a trade and some new information might have entered, or the market is telling you that something, this may not be sustainable, so you get out. That's fine. It doesn't have to always be these big green bars, but you get the idea where you're looking for something where you're closer to the middle without significant outliers to the red, rather more outliers, hopefully, ideally, to the green. And you have things like your return rate. We're going to go through what these mean, but you have your return rate, and it'll tell you your return is above 1. That means your strategy is making money. You've got your win rate, for example, 37%, 370 out of 100 trades were closed in profit. And then you've got 1.6, your profit loss ratio, in this example, 1.6 to 1, your average profit compared to a loss of, say, that amount. Then it also, what's really nice is it tells you your average holding time for winning trades versus losing trades. Now, a lot of times, because we get stuck, psychologically, we can't get out of a trade, and especially if you're not using a stop loss, you will see a very large average hold time for losing trades, and you see a very short average time for winning trades. You want to flip that. You want to make it so that your winning trades, you're able to hold on. You're patient with your profits, and you're able to let it roll. And you're very, very impatient with your losses. I'm not saying you have to always take a loss, but I'm saying you have to generally be impatient. It also tells you what your best market might be. So if you're trading multiple items, it tells you which one you do better and which one you might do worse. Again, these are just examples. It does not mean that you should not trade GBP, JPY, although it is more volatile, and your GBP, although it is much less volatile. And then it'll tell you your markets and your true P&L, your true number of trades, your profit trades, win rate. So per market, it will tell you each one, multiple rows, different pages if you have different stuff to select, but essentially it tells you, breaks it down by each product as well. And that, of course, will help you to get a better idea of what's working, what's not, and how you're doing overall, without looking, of course, at your equity. I know looking at your equity and your funds, you'd be like, well, I know I'm not doing well, or I know I'm doing well because I can see the funds. This breaks it down into far more detail, so you can try to weed out those tactics that aren't working for you, and also the markets that may not be working for you, and sort of stick to the ones that maybe are.
Right, and so as I can see on the graph above, like this is for around 4 months of trading activity. Now based on that, should my aim be solely getting a higher win rate percentage, or return rate and these other other values I need to consider as well, just to have a sweet middle point of having a consistent strategy?
Yes, I mean, if you want to hit the sweet spot, we always think, if you're talking psychology, then the answer is, oh, I have to have the best win rate, and that's wrong. But by default, our psychology says, right away you look at it, return, win, profit. Oh, I want to win. I don't want to lose. Who wants to lose? I don't want to have a low win rate. You want to always, we think to ourselves, we want to win. But the problem is that, yeah, you might end up with a very high win rate, like 50, 60%. You go, yeah, I'm a winner. On average, I'm a winner. Yeah, but on average, those are closed in profit. But what if the return rate, or what if your profit loss ratio is off? So let's go ahead and break down each of those three. You got your profit loss ratio. So, and this is, by the way, available on the platform just in case, but the profit loss ratio measures the performance of your trading strategy. The higher the ratio, the better. For example, if your average profit was 600 pounds and your average loss was 200, the profit loss ratio is 3 to 1. But then you have what's called the win rate. Now, the win rate is a percentage of trades won out of the total trades executed, and the remaining will be losses. So, for example, you win 40% of your trades, but if your average profit is double your average loss, you'll still end up making money. So the idea is you want to combine the two. The win rate might be higher, but if on average you're losing a lot of money, when you're losing, it's going to fall into a typical psychological reaction of taking profit too quickly and letting losses run, when ideally it should be the opposite. And what does the return rate do? The return rate indicates if your trading strategy is on course to making money. This takes into account how often you win trades and your average profit and losses. So your return rate is equal to your win rate times your profit loss ratio plus 1. So what it really means is if your return rate is 1, you're going to be breaking even. Less than 1, you're losing money, even if your win rate is high. You go, but my win rate is up. It doesn't matter. You're losing a lot on those losses, and that's why your return rate is less than 1. More than 1 means you're going to be making money. So the aim here is not for the highest win rate. The aim here is for a return rate that's going to be higher than 1. So shift your focus to the return rate to think more like a trader. Otherwise, if you want to think like a human being, then yeah, everybody just wants to win. They don't care what happened. They don't care about the return rate or they just want to win. Like, yeah, I won. Whereas really, as a trader, you're thinking, what's my return rate?
All right, and so IG has started offering a stock trading account where you can buy long-term stocks and have physical shares. Now, it's always a tough call to find the right company. What are some tools that can give a better understanding to our clients that what market analysts our participants they think about that specific stocks? Are there any tools that we can use?
Yeah, so this tool, we actually had this one. This is a more recent one, what we call the Smart Score. So as an example, I've chosen Tesla not because I'm saying you have to trade it or invest it on a stock trading front, just because it's the one, usually the most popular traded one on our end, because on the trading side it's very volatile and traders want that volatility, whether they're going long or short on the CFD account. And then our physical stockholders, a lot of times they want to diversify from their own personal holdings that are maybe heavy on real estate, heavy on infrastructure or energy and commodities, and they want to diversify into tech. So that's why it's a heavily invested stock on the physical and stock trading side. So, but it's available for both. Whether you're trading Tesla, CFD, or as a stock trading, you will see the Smart Score there. It's found under shares and shares CFD. Tesla, for example, you will not find it under a currency pair like EURUSD or commodity oil because it's not a stock. So you're going to find this with stocks. So share CFD or physical shares. And just as an example, if you click on it, this is what comes up. So if you have the chart, news, client sentiment, and Smart Score, this is what you're going to go ahead and see. And in this case, I want to go ahead and just start to go through some of the items, but I want to point out this is from TipRanks. It's a third-party data vendor. I'm just not responsible for the integrity of data provided, a bit like those signals that you're seeing for those third-party providers. Now, the thing about some of this stuff here is you've got, in this case, you'll have, for example, analyst consensus is a hold. The reason why it's a hold, it's not that you might think, oh, okay, well, these guys were bullish before, so why is it that they're at a hold? It's because their average price target, for example, is 270. And at the time when I took this snapshot, the price was hovering near it. So if they've already reached the target, it's like they might have been bullish, they might have had a overweight, it reaches their target, and then you start to see some of the analysts, if there's been no change in the fundamentals, they might say, okay, now the analyst consensus, there are many of them, some of them will say buy, overweight, underweight, strong buy, strong sell, but the average that taken from TipRanks is for a hold. You got blogger sentiment. It doesn't mean you have to follow what the bloggers are saying. You got the hedge fund trends. What are they doing? Insider transactions. Are the executives in the company? Are they buying or selling? Some people, there are some times where if an insider transaction occurs where someone inside, they're selling, and then it hits the wires, you see the stock price fall. Why? Because they're going, well, if they're selling, are they not that bullish about their own company? Aren't you supposed to be bullish about your company? Aren't you supposed to be buying why are you selling your own shares? Now, it's not fair to say, oh, they have to put all their money and pull everything into the company that they work for. It's understandable. Everyone wants to diversify. But when they do that, a lot of times it's seen as a little bit of a negative. And when they are purchasing more, they go, oh, well, that's a relative positive because that means they're taking their own money. They're buying into it. You got your crowd wisdom. You got your news sentiment. You got your technicals. You got your technicals based on moving averages and technicals based on momentum and your return on equity, and then you got your asset growth. And then at the end, you've got this score over here. And the thing about it is that this stock rating system ranges from a high score 10 to the lowest 1. And usually if it's 8 to 10, it's outperformed. 4 to 7 are a bit neutral. I mean, this is now 7 is like you're on the verge, almost to the outperform. I want to say it's a slight buy bias based on TipRanks Smart Score. And then stocks with 1 to 3 are considered underperform. And so that's when it comes to shares and Smart Score.
And then how about like FX, commodities, indices, and those markets? How do we look at them?
Yeah, so a lot of times, shares are popular on our end in terms of trading as well as investing. The most popular, we do have indices, and amongst our top 10 products, it's usually you got the key indexes like the S&P 500, which is the US 500 on our platform. You've got Dow 30, which is Wall Street. US Tech 100, that's the Nasdaq 100. Germany 40, DAX 40. Then you got EURUSD, GBP/USD, and yes, especially out here, we're doing this out of UAE, out of Dubai. So you got gold and oil, quite popular in terms of commodities. So to do that, what we do is we do have our market report. In this case, the weekly. This is the report that I do. The weekly is released on Mondays. It does include the week ahead, so you've got all the key items for that week. So if you're trading a certain item and you want to see what the impact potentially could be, that's also there. And then the daily market report with daily levels. So the weeklies with weekly levels, weekly sentiment changes, weekly strategies, and weekly overview. Whereas the daily, we're zooming into the shorter term time frame for those of us who like for more intraday trading. So you got daily shifts in terms of sentiment, daily changes in terms of sentiment, strategies, overviews, as well as the intraday level. So there are those who say, I'd like to have the daily levels on a Monday because they want to trade those levels on a Monday, even if things are a little bit sedate. And it's released 9:45 a.m. Dubai time, so it's before the European Open. And I know because of daylight savings, it's either 10 or 11 a.m. Out here in Dubai. So basically you're getting it either 15 minutes or an hour and 50 minutes before the European Open. And the goal, of course, is because there are those of you who are trading the European Open. You don't want to have to wait until after the session is over and then the report comes and then you plug and chug. A lot of times, a lot of our traders want to get in. They want it before everyone else. They want to get in there early. They want to set up their trades. They want to have the information before the European Open. And that's the reason why we really, I strive to make sure that you get that before the European Open. As for the products, these are the most popular traded products here at IG. Euro USD, pound against the dollar, USD JPY, Australian dollar, gold, oil. And then I mentioned those 6 indices. And Bitcoin is also available on the weekly. We usually put those on the weekly because of the action is usually more intra-week. So we do have Bitcoin as well. You can see the sentiment and everything on the weekly on Mondays, but not, of course, for those of you that are watching out of the UK. We do not service crypto for that region. And then there is a guide, but you've got basically the fundamentals, you've got the technicals, you've got the overview, you've got the levels, strategy, sentiment for both IG clients as well as institutionals. And then, most importantly, I do put for levels stop losses, not take profit. Take profit because I know we don't have a problem taking profit, right? We have a problem in terms of putting a stop loss and closing out, even if it's in loss. We have trouble taking a loss. So I always stress mentally to put in our minds the stop loss, because by default, I don't think anyone needs a mental note about taking profit. And another thing I want to add is that sentiment, because there are people who trade just on sentiment, and we've done a video just about on sentiment, but that sentiment is plotted onto the chart. So COT institutional sentiment is on the chart, so is retail sentiment. So you can see how traders got to where they are and what they did at each of those price points.
And you mentioned about that you make some videos as well. So I think it would be good if we can share a bit of details with our attendees as well on the videos that you make.
Yeah. Okay. So we've got IG. Our YouTube station is IG MENA. I mean, we do have our Instagram, which I'll share in a bit, but IG MENA is our YouTube station. We've got platform walkthrough videos under the platform tutorial playlist. So when you go to IG MENA, you go to playlist, you go to platform tutorial, and you've got a number of platform walkthrough. It's also available in Arabic for those of you out here in the region that speak Arabic. You got as well for MT4 for those interested, as well as programming, backtesting, and parameter optimizations, trading options, stock trading. And there's also, we have the week ahead playlist. And by the way, the sentiment video that I talked about, it's in this playlist as well at the bottom. So you can also, for those of you that are interested in terms of trading sentiment, we also have the week ahead playlist. And there I put the week ahead videos, which is released usually on Monday, as well as sentiment study for those who like to trade just on sentiment. So we recently put one for if I recall, the pound, and we also had one for the euro for those that are interested in trading that.
Some basic tips you'd like to give in the end?
Yeah, just some things. One thing I want to point, and this is, of course, we're talking about when it comes to CFD trading. You want to start and stick with one product and maximize your screen time. At most, maybe trade 2, but you might want to try to note other markets as you progress. And you can use our watch list, creating a watch list on our platform. I can pull that up later if need be to show you guys where it is, but we usually cover that with the platform walkthrough tutorial. But essentially, you can try and note other markets as you progress. And for example, especially to know where the source of the movement is coming from. So, for example, risk appetite in iron ore when it comes to the Australian dollar, or oil for the Canadian dollar. Again, the relationship doesn't have to always be one-to-one. The correlations might break from time to time. The risk appetite and yields, for example, when it comes to the yen. But ideally, you want to know where the source of the movement is coming from, so you can have an idea and say, oh, it's not the yen that's weakening if I'm trading USD JPY. It's the dollar that's strengthening against everything, for example. That's what's driving this, and therefore, and you can base it accordingly. And you want to avoid, at least in the very beginning, you want to avoid gut feeling, because you don't really know. We don't know the market that well, right? In the very beginning. So if you don't know the market that well, you don't want to rely on your gut feeling. Now, as you get better and better and better, and you start to maximize your screen time, and you start to get to know your products and understand the counterparties involved and the market makers and the liquidity provider and so on and so forth, then you can start to say, okay, maybe I want to rely a little bit on my gut feeling, but within reason, first off, and second of all, with precision. So you want to prepare ahead of time and say, okay, if my gut feeling has a little bit of this, maybe I want to do a little of this or change a little bit of that, tweak things a little bit around the edges, not change your whole strategy, and sort of shift things midway in the middle of a trade. But just to recap some of the most common mistakes: taking profit too quickly, which means we have to learn to be patient with gains. Stop loss usually is non-existent, which is a problem. Overchanging them as the market moves against, which means we want to utilize both stop loss as well as trade analytics. And of course, averaging, and we want to avoid as a strategy, although averaging into a position, which is where you break 1 into 4, that's okay.
Right. We do have. So Mr. Mohammed has asked some related to the trading fees. I've already sent a link in the chat, and you can check it there. But just to give you an overview, the question is that how do we calculate our trade fees, or what kind of trade fees apply? So there are different markets that IG offers here in Dubai. We have a CFD account, we have a stock trading account. On the CFD account, we have FX, commodities, indices, shares, and all these markets. So just to split it slightly for better understanding, if you're trading on FX, commodities, indices, and cryptocurrencies, we are charging the spread. All right, a spread is the difference between buy and sell. Now, how you calculate the spread is basically in the link you can see the formulas as well. So, but you take the spread, and then depending on what is the number of contracts that you have and the value per point, and based on that, you can calculate your spread. And then if you're trading on the spot markets, there are overnight fees that would apply on that as well. Again, in the link, you can find the calculation. And on the stock trading account, if you're buying actual physical stocks, you're actually having $0 commission on US markets, considering that you do not exceed 50 trades a month. So yeah, that's just a basic overview of what kind of trading fees we apply. The second question that we have here is that how can I get cash out from my trades to UAE bank account? All right, so that means you already have an active account, you have placed a few trades, and now you've booked some profit and you want to withdraw your funds. So actually it's very simple. You can go to the IG dashboard, select the account from which you want to withdraw the funds, click on withdraw funds. You can do partial withdrawal or you can do full withdrawal as well. Put in the amount, how much you want to withdraw, and it will show you the destination as to which bank account you want to send. Ideally, we would like to send the funds back to its source account where you sent us, so that would already be registered there. When you click on the withdraw, the funds will come back to you within 2 to 3 working days. It's up to you. If you want a refund, you can use a debit card, not a credit card on retail accounts. You can only use a debit card, and you can also do a wire transfer. The banks that we use, it's Emirates and BD, or that's our bank, where our bank account is. So the funding and withdrawals are fairly quick. We do have another question. Have any tax impact from dealing in either CFD or stock accounts? So from our end, we won't be able to give you any tax advisory. We're not qualified to give you that information. I believe you need to consult with a tax advisor or professional to give you a better understanding on your tax-related queries. However, from IG side, I mean, normally you won't see like a specific tax applied on your positions on your statement. Still, I would recommend every resident in UAE, they have different relations with their government, what they need to pay, and here in UAE. So I think a tax professional will give you a better answer. So far, these are the questions that we have. Is there anything else you would like to add on, Monty?
That's fine. Just I think in terms of with the stock trading account, just to keep in mind that if there are going to be any taxes on the charges that you see there, it's not from us, it's from the exchange. As far as it's not from our end, it's going to be from the exchange end. But if you're talking about, tax from making money off of something, then yeah, as you mentioned, see your accountant. Depends on where you reside and whether you're a citizen, of a country where you still have to pay back to that country or not. So I'm not going to add too much on that. We're not tax advisors, so I'm not going to add too much to that beyond that. But yeah, that's you pretty much covered it, Faizan. Thanks. But yeah, if you guys have any questions, feel free to ask. Even on product, as you noticed, Faizan, he's what do you call it? He's more than well equipped. Has this inside out on these items like trading fees and accounts and things like that. But if you have a question on the markets in general, also feel free to ask that. This is about tools. This is about risk management. But if you have a question in general, feel free to ask it. If we can answer, we can. But again, yeah, tax and legal maybe won't be the best, not the best combination for that. But yeah, otherwise feel free to ask.
We'll wait if we see any more questions.
Yeah, usually there might be someone might be typing a little, might be typing a very long question. So I like to give it like another minute or two. Yeah.
All right, so we do have another question. It's how to deal with margin calls. So I believe there are two aspects of it. I'll explain from an account, sorry, like from IG and you having an account with us from that point of view as how it works. So a margin call is usually applies on your account. The policy is that if your equity drops below the 50% of the margin that you're utilizing, then your account goes into a margin call. That means that you need to top up your account to stay above that 50 level, or your position would be closed out. So normally within 24 hours, a position gets closed out, but that's not certain. Your position may be closed out because the markets can be very volatile and we may see a drastic drop in the market. So due to high volatility, your position may be closed out. So that's kind of a margin call policy and how a margin call applies. You will receive an email from IG when you start going down to like 80%, 70%, but we like I won't rely on that entirely that, okay, I'm waiting for an email from IG and then I would just consider maybe topping up the account. You need to monitor your own position. You are responsible for that. It's a CFD trading account. So dealing with margin is risky. It's a risky product. So you should keep an eye on it and make sure that if it drops below the 50% of your equity, then you should top up the account. But apart from that, on the other side of it, I just want to take Monty's view on a margin call, as in some markets are very volatile. That prones you to getting into a margin call quickly because the market drops quickly. What should be the strategy in this case as to choose or how to deal with like very volatile markets?
Yeah, I mean, since we were talking a little bit earlier about stocks, let's say CFD stock trading for a moment, because we're talking about margins and stuff. For a stock to go down, a single stock like Tesla, to drop, for example, 4 or 5% in a single session, it's not unheard of. It can happen. It has happened, and it certainly can happen in the future for it to move 5%. So whether you're short or long, to get the same type of movement from an index, which is tracking, say, 500 companies, is far less likely. So you look at an index like the S&P 500 or NASDAQ, US Tech 100, even US Tech 100 usually is a bit more volatile just because it's got more growth stocks that are more prone to volatility. But even you look at those and the moves a lot of times, most of the time, day in, day out, you look at moves of sub 1%. Oh, it went 1.5%. Oh my God, 2%. That's massive. 2% is huge. Whereas someone trading a single stock, 2% is nothing, right? So we talked already about how you obviously want to note what your margin is and how much of it's going to take out if you're wrong, say 5 or 10 times in a row. And if you're averaging into a position, for example, we talked about how obviously you want to limit that, but also when it comes to something that's just prone to more volatility. One tool that you can, this is a technical analysis tool, and I'll pull up just a second over here. But one thing you can do, I'm just going to go to a demo account just to show this. But one thing I like to look at is average true range. So if we want to go ahead and just take a look at one of the indices, I'm just going to take US Tech 100 as an example. I'm going to expand it, and then over here under indicators, I'm going to click on this, and then you go average true range. You want to go to the daily time frame so you know how much it moves, what the average range is within a single day. But this gives you an idea of how many points it could move. And then of course you want to zoom out a little bit to go, okay, now we're in a pretty range bound moment, but how bad can it get? How high can it get? And you can even change it up and say, okay, I want to look at it with just averaging 2 periods, and this will give you a much better idea of how high, so you're not surprised when you get these big moves. I know this was on a day when something major was happening. A lot of times it's because something big or fundamental is happening, but that's just an idea. So you have an idea ahead of time and go, okay, you know what, this is how much it can move in just a single day. So, what if it's trending? What if it's day in, day out? Then I need to add up, 200. It's not going to go, you're not going to have like 10 days of gains in a row. That's usually less likely, but basically you're looking at, okay, 10, if worst case scenario, 200, 200, 200, and then you sort of add up and then you have a better idea of how it goes. So that's a good way to look at a product. And that's why when I mentioned, when I was looking at the trade analytics, you saw Euro GBP and GBP JPY. If you want to see an example of why that is, because GBP JPY is one of the more volatile pairs. So if we want to look at it with a technical indicator, you're going to see, look how volatile it can get. On average, you might think, okay, there are days where it's quite volatile, but even then, about 1 point. Whereas let me go ahead and pull up Euro GBP, see if I can find it here. Here it is. Let me go ahead and add this to the workspace, and you can see it's much, much, much less, 0.03. So the movement and the action intraday is far less than 40 points versus what we see with GBP, JPY, where it can easily be a lot more. Now, I know there's been a lot happening with regards to the yen as well as the pound that we're seeing this kind of volatility because it's the pound against the yen. But just an idea that this is when you look at this and you go, whoa, that's way too volatile. Okay, well then maybe you want to avoid it in terms of as a product. So average true range is what it's called. ATR, average true range, is the second one under technical indicator when you go to your chart. I do find that as a very helpful technical indicator to help you figure out. I mean, you obviously want to have screen time with your product, as I mentioned. But if you're looking at a product in the beginning, you're going, well, I have no idea. Start with that at least to go, okay, you know what? That's a little too volatile for me. That's beyond my appetite. And then, of course, that's aside from looking at, again, you got to look at margin and so on and so forth.
And we do have another question related to S&P 500. So on the chart, there is a £1 contract and a $1 contract that we can trade into. What is the difference between them? All right, I'll take this question. So on IG platform, it is designed in such a way that you have we have categorized all products into different contract sizes. So to make it easier for our clients, that if some clients wish to trade a standard contract, which would then be the biggest contract, as you can see, $250, it's written in the brackets. That's the value per point. That means if the market moves by 1 point, you gain or lose $250. Now, if you see US 500 cash £1, this is trading in pounds, ideal for clients who have a base currency of GBP. Please note that by default, if you open an account here at IG Dubai, you will have a base currency of US dollar, but you can also request for an account in GBP or euro as well. So if you want to trade in US 500 cash and you have GBP funds in your account, you can select that contract. Plus, it's a small contract. It's just £1 only. So it's a kind of a micro contract or a mini contract, I would say. So yeah, the platform, throughout the platform, if you go into FX, you will see Euro USD, a standard contract. And how you identify that, in front of that, nothing is written. It just says Euro USD. While if we see this one, it says Euro USD mini. So the mini would be then a smaller contract. So yeah, and you see this theme throughout. One more thing, how do you identify whether it's a spot or a future? So if you can see the cash ones, they don't have any date written in front of them. However, if you click on futures, Monty, yeah, you can see it says December 23. So if you click on that, Monty, and go to the info for that, and then click on expiry. So you can see it has an expiry. So the difference between spot and future contract is that if you buy the spot market, US 500 cash spot, and you hold your position, there will be overnight fees. So you can hold it as long as you want, but you would be paying overnight fees. However, compared to that, if you buy the futures, it would have an expiry, but there will be no overnight fee. One important thing, that the spread between spot and future market is different. Usually the future market is slightly wider, but that depends mostly on your strategy. So if you have a strategy that you are planning to hold, let's say, gold for a month, then a future seems slightly more reasonable, because you can buy and you can just hold it for a month. When the market conditions are right, you can sell it, and there won't be any overnight fee. You just pay a wider spread, and the wider spread is not too drastically wide, but for example, on gold, it is 20 to 30 cents on spot gold, whereas on future, it is 50 to 60 cents. So yeah, this is how the whole platform is kind of like, there's a theme to it, and once you get to know these things, then you can find the right product and you can trade accordingly. Yeah, I hope that answers your question. We have another question. Can you walk us through the options screen? All right, so, options,
I think
CFDs.
Yeah, I think what I'll do in this case, just because we're a little low on time, but what I will say is this: it's a big thing to talk about the options. But if you go to IG MENA under playlists, IG platform tutorial, view full playlist, and there's a video there because we've had other people ask about options. I've done a long video explaining options. I explain options and I explain trading options with IG. That's also where you can find the sentiment, stock trading, and all the other platform walkthrough videos. But here's where you'll find options explained is what it's called, and trading options with IG. So I think that would help summarize it best, because if we go through the options now, I don't know if we have much time for that.
Yeah.
Are there
Just one thing, the options are CFDs. All right. So there will be leverage and margin involved in that.
So
I don't see any other question.
Yeah. And just to add, like, so the options that I explained what an option is, and then trading options with IG, which is a CFD, as Faizan mentioned. So that's the reason why there's a big difference between the two, because sometimes people come in thinking it's a regular option. They don't realize that they're trading the difference in the premium. So.
Just one more thing I want to add. Among the tools that we have, I believe, if you look at IG Academy, that's one of them as well. If you're a beginner, if you're new into trading, I would highly recommend going through IG Academy. It's an app that you can download on your phone, on your tablet, or you can just directly log into our website and get access to it. Considering you do have a demo account, so you can get access to all these courses. IG Academy has around 8 courses, and it really helps you develop your trading skills. It makes you a very organized trader. It helps you become, so you can see here, yeah, thank you, Monty. It starts from introducing the financial markets and then going on towards psychology of trading and some very key basic terminologies that are used in CFD trading. They're really well explained, and we are always updating them with new courses. So please do check it out. It has videos, exercises, and a lot of graphs, and we have put a lot of work into this to bring it to you, and it's completely free. So there are no charges. We focus on educating our clients. That's our key goal. We want you to be educated, as trading can be risky. Our aim is to provide you with all the resources so you can make an informed decision.
Okay, looks like no further questions have come through. We'll just give it a few more moments just in case someone's writing a really big question for us, which we'd be happy to take, by the way. I'm not trying to say that we don't want that. More than happy to take a large question. We'll just give it a few moments just in case.
We do have a community as well, by the way, IG community, where as we are a global company, we have 15 offices around the world, and we have 330,000 plus clients. So we do have a community, a very rich community that you can join in, ask questions. There are forums. I mean, most of the questions that you have, they will be answered there as well. So that's a good way to interact with other IG traders as well. It's available on the dashboard. If you can just go to my IG. Yeah, the community, it's there. So yeah, you can also get quite a lot of benefit from there. It has around 43,000 members there. Very informative and rich. And our analysts, like Monty and other analysts around the globe, that they do post their own articles there as well, so you can stay updated with the market. It
looks like we haven't gotten anything through, so we're reaching the end of our webinar. I want to thank you guys so much for joining us, and hopefully we see you guys again. Happy ticks.
Right. Thank you all. Have a great evening. Bye.